If you're looking to buy Redbox Entertainment stock, then please keep watching this video because we're going to look at its recent news, the business model, how's the market treating it, what are the technicals telling us, and most importantly, what should be the best trading approach. As the market remains volatile for the moment, and rather on a downward side, we should always be careful about which positions we take on, as well as their individual timing and exposure. Before today's video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Redbox has always been an amazing ride, and it has left people wondering if they can still climb on the gravy train. The reason why people were interested in Redbox in the first place is because it has multiple aspects that are very similar with GameStop. It has a massive short interest, meaning there's a huge number of short positions waiting for the stock to go down, and its fundamentals are almost irrelevant and maybe doesn't help that much compared to where the future stock price is going to go. Redbox is a company delivering DVDs to clients for those who still want to watch movie via this medium. Basically, what Blockbuster used to do before Netflix and other streaming platforms took over that part of the market. This is why its appeal isn't really the business model or the financial results. And frankly, it has never been the financial results either, but the amount of people willing to push the stock price up and how many short orders are left. Right now, there seems to be a huge amount of short positions remaining, something around 2/3 of the outstanding volume apparently is going towards the short orders. So what this means is that these orders have to recover at some point because they would be paying financial cost to brokers as long as those positions remain open. I mentioned previously that Redbox would probably go through a period of retracement before continuing to go higher up. So I think that this retracement has fully occurred so far, and that the timing might be right for another round of bullish runs. Before we go further, let's take a look at the technicals of Redbox. The trading volume of Redbox is currently around 4.6 million shares versus the average volume of 11.7 million shares. Over the previous 52-week period, the price fluctuated between $1.61 and $27.22. The volume of shares traded can tell us how many shares are being bought and sold at any given time, and if there is enough liquidity to support your trading strategy, as well as how much exposure you want to have in any stock. If the float is very thin, it's going to be very easy or relatively easier to influence the stock price around. But the same low liquidity could also limit your possibility to exit a position or a strategy. So it's always going to be a game of balance going forward when it comes to volume and how much you want to buy. As we compare the current volume against the average volume, there can always be a possibility to spot a trend reversal or breakthrough as well. For example, if the stock were to break through, the current volume would be significantly higher than the average volume. Same thing for the reversal, but the other way around. Let's say if the stock went down for a number of days, and at some point you see that today's volume is like 500,000 shares versus the average volume of 11 million. Well, in that case, what it means is that there are so few people buying the shares or selling the shares that something big is bound to happen. So this is also something that volume can tell us. The market cap of Redbox is around $209 million for an enterprise value of $297 million. Simply put, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is often the cost the company has already paid for the assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies are intangible, meaning they're not items that you can see or touch, but they're more like pledges for a brighter future. For example, schematics for new products, intellectual properties, brands, and also goodwill. So for startups, most of their valuations are based on those intangibles, which might be valued in more favorable market conditions. In concrete terms, what this means is that there could be a huge difference between the market cap and the enterprise value, which gives a false impression to the market participants that a company might be trading at a discount. It's only trading below the book value, but that doesn't mean the company itself is undervalued per se. It's also possible that it was overvalued to begin with and only deflating back to somewhere normal. As we compare the current price to the historical price fluctuations, the stock is 62% higher than the 1-month low, 84% higher than the 3-month low, and 177% higher than the 52-week low. On the options market, which gives us a hint on where the market sentiment could go next, the implied volatility is 181% versus a historical volatility of 243%. The put-call volume ratio is currently around 0. In other words, there's currently little to no demand for put options and to cover any possible downsides. The most recent volume of options traded is around 260 contracts a day versus the 30-day average of 516 contracts. For open interest, the most recent volume of open interest is around 82,000 contracts versus a 30-day average of 98,000 contracts. The option contracts are tools allowing traders to hedge their risk, increase their exposure with limited downsides, or a revenue stream. They are excellent derivative products based on underlying security that can give traders the possibility or the opportunity to buy or sell the security at a predetermined strike price, which limits the potential downsides. The put option allows selling at a strike price, usually chosen for the anticipated downturn, and the call options allows buying at a strike price for an anticipated bullish run. In terms of shareholder structure, institutional shareholders own about 270% of the outstanding shares. The biggest shareholders include Apollo Management, Vanguard, and Cutler Group. Usually, it is better to see some institutional participation when holding a stock long-term because it offers a layer of stability and token of reliability in the medium to long term. It means that the market is confident that it'll deliver value for the long term, which is a very important factor to bake in. I personally consider that if you want to hold for the long term, there should be a minimum threshold of around 25 to 30% of institutional ownership. But there are many exceptions to this rule, as there will always be great companies mostly owned by retail traders, and there could always be horrendous companies mostly owned by institutionals. Let's also take a look at the short interest of the stock, which is the number of positions that will profit from a falling stock price. The way it works is that short positions will borrow the shares from the broker, sell them in the market, and buy them back later, profiting from the difference between the two timings. If there are significant short interest, usually above 25 to 30%, there could be a potential for a short squeeze, whereby traders will buy the stock up, forcing those with short positions to redeem them in order to avoid further losses, acting as a buy for the stock's price action. This is what people refer to as a short squeeze, and it became a popular concept in recent times, with stocks like GameStop and AMC being successfully short squeezed. The current short interest is about 63% of the total float, and 58% of those transactions are coming out from the dark pools. Usually, if there is a short interest of above 15% of the total volume, with a significant chunk of it coming out outside of the public exchanges, this may suggest that there are institutional positions taken to short the stock, and that there could be potentials for a short squeeze. And it's definitely the case for REDBOX at the moment. In fact, I would argue that this is probably the only game in town as far as this company is concerned for the moment. I would recommend to commit a maximum of 3 to 5% of your portfolio's capital on REDBOX, and would also recommend to split the allocation in batches of, I would say, 5 to 10% at a time, so that you could purchase more in case it retraces further. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.